So obviously the market has been shifting quite a bit over the last 3 to 5 months. We've entered a completely new environment. Now, there are still opportunities, in my opinion, of being able to properly acquire multifamily and actually be able to get good deals. But if you're gonna be acquiring today, I do think you're gonna have to be sensitive to a couple of different financial metrics. So I thought I would shoot this video and talk about those exact things that I'm thinking about if I'm gonna be acquiring multifamily in today's environment. So with that, let's get at it. What's going on, guys? My name is Lior and welcome back to my channel. Now, if this is your first time on my channel, first of all, welcome. Second of all, make sure you smash that subscribe button for me. I put out literally daily content here talking about everything on multifamily investing, from construction, operations, deal analysis, execution, and everything in between. So if this is the kind of content you're looking for, make sure you subscribe to my channel. So as I said in the intro, I wanted to shoot this video and talk about the few financial metrics and deal structuring metrics that I'm thinking about if I'm going to be buying multifamily today, right? With the interest rate environment today, it's become more complex than ever to properly structure deals, but it is certainly possible. So here are two things I am thinking about. Number one is on your equity and debt side of the deal structuring component of it. And I think if you're buying any sort of multifamily deal today, you really need at minimum a 3 to 5 year timeline and potentially longer, right? And I think the implication for that, especially on the equity side, is when you're having communications and if you're gonna be raising money for your deals, you need to make sure that the equity understands it needs to be a little bit more patient than it has been in the past today, right? Because a near-term exit, I think today, is gonna be real tricky. In terms of selling, obviously it's gonna be much tougher if you're gonna be trying to flip any sort of multifamily, right? Because you're gonna be selling into a very high interest rate environment. The Fed still predicts that, the rates are gonna continue to going up. So if your plan is to sell and return equity that way, I think you're asking yourself for a little trouble. But even on a refinance side, right? Obviously a lot of people add their value in a value add strategy and then try to refinance to pull out some equity. Given that we're gonna have higher rates, it's unlikely that's gonna be a sustainable strategy for the near term, right? So whether you're planning on a cash out refinance or a sale as your exit strategy, I do think you need really patient equity today. So, I would be having conversations with equity investors, understanding that, yes, you can still buy good deals and, you can still go through the business plans, but it might just take longer to actually exit and return back some of the capital. On the debt side, I think very similar themes, right? Is basically you need to be careful with anything that's short term, right? So that includes any sort of bridge financing you might be taking, any sort of additional private debt that you might be layering onto your deals, right? Anything that kind of has a short expiration date on it, I think can be a little tricky, right? Because again, you're probably going to be refinancing or selling the asset in order to pay off some of this bridge, some of the bridge debt or any sort of short-term debt that you might be taking on. And just like I talked about with the equity side, both a sale and refinance is going to be a lot trickier and a lot harder in an increasing interest rate environment, and obviously with recession on everyone's mind. So even on the debt side too, I think you need to be really careful about what kind of debt you sign up for today. And the second kind of sensitivity I'm taking in my analysis today as I'm looking at potential acquisitions is the sensitivity around your exit interest rates and cap rates, right? Whether your strategy is to sell in the future or refinance, you're gonna be selling into an increasing environment, just like we talked about, right? So what that means for you is that, what I'm doing in all my underwriting is increasing my exit cap rates if I'm gonna be selling. And I'm stress testing anything from 50 basis points up to 150 basis points, even 200, depending on the exact deal and the market, and the exit interest rate if I'm planning any sort of potential refinance in the future, right? So, I'm stress testing anything from 50 to 150 and even 200 basis point increase on the interest rate on the refinance, if that's going to be part of your strategy, right? And again, I think this is taking uber caution. But given with what's happening today, again, I don't think it's necessarily out of this world to think that, you can buy product today at 5 or 6 caps, right? Or whatever your market is trading at, in 12 to 24 months, those cap rates could easily be 6.5, 7, 7.5 caps, right? That's not insane to think about. So I do think you need to be stress testing them and really putting in, like I said, 50 to 150 basis points at least potentially even more if you really want to be super, super cautious. So those are the two big things I'm thinking about, right, on the deal structuring side. The duration of the equity and the debt. And then on my exits, I'm thinking about the interest rates and cap rates of what those would look like if I'm going to be unloading an asset that I'm buying today. So hopefully that's helpful. Again, I still do think there's plenty of opportunity. And I myself, I'm going to continue to look to buy properties, but I'm going to be much more conservative and really stress test a lot of my assumptions. And just make sure I'm not putting myself and my investors in any sort of stressful situation. So hopefully that helps. If you agree or disagree, make sure you put them in the comments below.